Hello, friends. Welcome to Nirmal. This is Piyush Jain, and today we are bringing a conversation to you on the markets with a market veteran, a market expert. He doesn't need any introduction. He basically has been in the industry, in the mutual fund industry, for over 2 decades. His volume of work has actually been across mutual funds. Let me welcome our guest today, Mr. Swarup Mohanty, the CEO of Mirae Asset Investment Managers India. Sir, welcome to the show. It's a pleasure for me to again be talking to you after some time.
Thank you so much, Piyush. So good to talk to you.
We basically, now if I start the conversation from the perspective of mutual funds, over the last couple of months, we have seen that the net flows in the mutual funds, those have largely been flattish. So let me start the conversation here from for our viewers, for the investors, to really understand what's happening at present from a top view perspective on the flows. Are we seeing any sort of redemptions happening in the equities or in the debt? The numbers prima facie were telling that we are seeing redemption in debt, but the equity remains resilient. So help us understand.
Yeah, Piyush, I think it's a very interesting question and it needs some discussion because I think at the investor level, some very basic structural changes have happened. And I'm very happy to say that, first of all, the approach to the asset class of equity has been changing by the day. Because when you look at it from a flow perspective, and especially the SIP investment side, that flow is continuing uninterrupted, right? 13,000 onwards per month. If you look at the backbone of Indian stock market today is the 1.5 lakh crore that will go from mutual funds. And that you couldn't say 3-4 years ago. I mean, and it's a buyer. We are a buyer at all falls is a reality because of the SIPs that we get. But I can't say the same thing for lump sum yet, because the lump sum investor is not behaving as steadily as the SIP investors. There, as you rightly said, there is a little bit of fluctuation because what had happened is post-COVID, the surge in the market showed the near-term return to be very, very strong. And typically, and that's something which all of us have been fighting, is to impress upon investors that, higher the near-term return, lower the allocation should be. In fact, it should be the other way around, buy things which have not moved. But people generally follow the last 1 year return and allocation typically happens on that. The mutual fund flows sort of say that. Now, once you invest in that and the market shows a flattish turn for around 1.5, 2 years, those investors start wondering, you had come with some figure in mind and it's the other way around. So some amount of fatigue was bound to happen, which is showing up. But that is not showing in the overall net figures of the industry. And especially if you see last month at 15,000 net was a revelation to all of us, just showing that people are looking at accumulating India at all points of time. And the fact that they are recognizing is the long-term story of India being intact. And at this moment, the India data points being so isolated from the rest of the world is going down with investors quite well, is something which I'm very happy to say. But on the debt side, something very structural is happening. A lot of money is being moved out from open-ended long debt funds and getting parked in what we call the target maturity funds, which are the index funds, giving a good opportunity to investors to lock in the yields at this moment of time. I mean, clearly, these are interest rising scenarios, and it's a great time for investors to lock into some yields, which if somebody would have told me above 7 returns were possible a year ago, I would have said, just give it to me, I'll take it. And that is what is happening. Yes, on the debt side, the long debt funds are getting redeemed. And that same money, if you track month on month, that practically that same money is getting parked on the target maturity side of the mutual funds. Recently, we are seeing the revival of the FMPs, and some of the FMPs have started getting money also.
Right. And when you say target maturity, like what kind of maturity it would be? Shorter tenure?
I'm extremely happy to say these are very long tenure funds, 3 years, 5 years, and of course, till March, you get the indexation benefit. The investor is aware of that and taking the advantage of that, and hence the post-tax returns look fairly comfortable at this moment of time.
But sir, help me my understanding. If that was the case, that it's just a shift. Obviously, investors are doing their calculation and they're moving to FMPs as you're talking about. then ideally the flows should be showing a strong positive figure, a month on month. Equities, as you just said, it's resilient. But in debt, is it something? It's only a rotation, or there is also a sort of a last quarter churn which is happening?
No, Piyush, what happens is typically we don't, put the two together. That is the active mutual fund flows versus the passive mutual funds flows. If
Sure.
you just compare the active mutual fund outflow and put the last 6 months index inflow flows, you will see the correlation. I'm not saying the same investor is shifting from there on. From an amount of money perspective, the amount of
Yes.
money which is going out there is practically coming there. Hence, you see at an aggregate level, the AUM of the industry is intact.
Okay. And overall, from a global market perspective, how actually are you looking at the markets, Indian markets?
I mean, it's a very interesting story as we speak, because when you look at the broad globe, and it's never happened that in any such event in the past that the broad global economic cycle has been come to a standstill, and that's what happened in COVID. The entire economy of the world was put to a stop, and when that happens, the after effects are bound to happen. And if you follow that up with a war, which then has its own impact on commodity prices, then the double whammy of interest rates and commodities come into play, and that is what is happening at this moment. When you look at the interest rates of especially the US, we are talking about a 4 decadal high there. I mean, if you look at India as an impact, as a consumer level, my home loan rates have gone up from say 6.5, 6.6 to 9 quarter. You're seeing the slowly passing back of the margins to the consumer and the prices rising consistently in a regime where our 10-year has gone from say 6.5 to say 7.5. There it's gone from 0 to say 4. It's a 4-time high or 4-time jump for them. So the impact of this will be there for all of us to see. Some of the events that have happened over the weekend, over liquidity issues on some of the bankings, are some of the impacts just playing out, right? So the point I'm making is the global data is extremely fragile. And in an interest rate rising scenario, this is quite natural. Now, this will continue for how long is something which is for all of us to see, because 3 months ago we had concluded that the interest rate hike regime was almost behind us, and suddenly the US comes and changes everything. And if we are talking about a possibility of 6% in the US, we are back to the drawing board. So in this scenario, it is always good to be watchful and be open for surprises, and that is what will happen. And that's where the globe is at, and let's see how this unfolds as we speak. And it's time to track them on a daily basis. Is my personal opinion.
Okay. And as you just touched upon the weekend development, where actually we saw more than one bank actually, I should say, collapsing or actually moving towards the state support requirement in US. Uh, from the perspective of the Indian markets, like usually we talk about that's happening in US. Indian markets are good. Nothing is basically sort of really great concern here. As a viewer, as a sort of who would be watching us, uh, what sort of strategy or what sort of outlook they should actually prepare when they're hearing something which is happening in USA? And you just highlighted a lot of interest rate hikes. They investing in mortgage securities, not able to sort of get it sort of corrected, and we sitting here and seeing those developments. What we should really strategize for investments.
See, Piyush, the great part of what is happening is that India's data points have never been so isolated in my entire working career. I
I
mean,
agree with
you
you.
take you take any data point from power consumption to four-wheeler consumption via GST to medical insurance to whichever data point you take. The data points of India are intact. Add to the fact that slowly but surely the manufacturing part of India is also beginning to fall into place. It's still a long way away, but what used to be a completely FI driven country is slowly but surely shifting gears to becoming an FDI country. And that's a journey which will unfold in the next 5-10 years. Whoever might say what, We can debate of when it will happen, but we cannot debate the fact that this 3 trillion economy is going to 6 trillion. That is the underlying. When you look at global money flow, and because of opportunities in other parts of the world, maybe the FI money might go to other parts of the world because the Indian markets look a little overvalued for them, maybe in the short run. But once this settles down, there is no data point which is like India in the next 5-7 years is a reality. And now the opportunity for investors is between now and then. More often than not, you don't get this opportunity to accumulate. Yes, because of the data points of the world being wherever they are, our conviction will be tested, maybe tested more towards the second half of the year. But the person who sits in the market and continues to accumulate over this period of time between our data point being wherever and being realized by the world is the person whose portfolio will see a very different trajectory on wealth creation in the next 5-10 years. If you isolate that also, this journey of 3 trillion to 6 trillion is also a great journey to be in. And trust me, this benefit of the 6 trillion will only come back to the investor through the capital markets. It will come back to that investor who's sitting in the capital markets, right? And that's something which all of us have to realize, and probably this would be the last that huge doubling of economy possibility that is there in front of us, because then the base changes and things start moving in a very different direction because the base becomes 6 trillion, right? So till you don't realize that, you might be outside the market, but the person who realizes that should be in the market more often than not, right? That's my first suggestion. The second one is typically equity gives you opportunities time and again, but right now, from a debt investing perspective, the investor is spoiled for choice. These kind of yields will not be there for a longer period of time. And because of the tax benefits that are there through indexation by March, it's a good opportunity to allocate or fill up your debt side of your allocation at this moment. You won't get, if these yields remain for a longer period of time, trust me, the problems in the other side of our lives in the form of inflation and the impacts of that will be significant. So understand the situation that we are in. As an investor, one is spoiled for choice because the longer term horizon view on India is intact and stronger post COVID. If you look at the same country before COVID, a country which had practically slowed down, right? So be prudent in your allocation and be a little long term in your approach, because your resilience could be tested because the markets could see a fair amount of turbulence in the next 6-8 months.
Right, so let me ask you a tough question because you'll have to actually find a way to answer me. But for our viewers, let me ask this question, because you're highlighting the debt part. We have some days, the viewers will listen to you, will plan out. And I was looking at all the funds here. Shorter durations, whether it's cash management, corporate bond fund, short, ultra short duration, short-term funds. There is one basket which has consistently given between 8 to 9% last 3-year average. I took a lot of debt names. There are equity sort of funds where we have sort of hybrid of equity, debt, and arbitrage. When they look, and we all know that Mirae has performed very well. If you take an average of 3 years, the funds have done well. So when you look at all these funds, and as you just said, if the viewers should lock in high yields, what is the sort of best fund sort of in the Mirae basket which we should be picking up? Maybe anything which you want to just guide or highlight from the basket of funds.
See, I mean, for us, the entire basket is in front of investors. It's up to them as to which fund they choose. But at this moment, we have highlighted this post-COVID, is that typically, contrary to what market says or the flow of the markets, please understand post-COVID, it is advantage large companies. It is advantage large balance sheets with good cash, because this resilience only they can afford, and if you look at any industry, pick up any industry, you will see post-COVID, the top 5-6 players have only increased in their market share. So in turbulent times, it's always great to stick to the larger names is what we should. We stick our neck out and advise, contrary to people feeling that, large caps don't have much, what can I say, scope. That is the flow of the industry saying that most of the money is shifting towards return chasing in mid and small cap. But the risk adjusted possibility in the larger companies is still intact, and the possibility of these companies standing tall in these turbulent times is also something which one should not, not recognize. So our view would be more skewed towards large cap. Our house view, if you have 100 rupees, 65 in large cap and 30-35 then balanced out between mid and small. We don't have a small cap, so we don't comment on small caps. But even today, we say 60-65% in the large and the flexi cap category is what we would recommend for the next 3-year horizon. On the debt side, the target maturities are giving you a great opportunity to lock in your yields. That's where it comes from. But just to reflect back, if 10 years ago, and that's why I'm highlighting more on debt and equity together. If 10 years ago, somebody would have told me that the large cap industry average return would be, say, 10.5%, and the money market return would be near 7%, industry average, my allocation would have been very different. Right? So this blind thought of skewing one's portfolio only to one asset class is never advisable. There are opportunities in all asset classes. Just respect the virtue of all of them. And at this moment, there are opportunities everywhere. So it's a good time to build a good allocated portfolio.
Okay, and so FMP is something which our viewers should definitely pay attention to March. And let's now go across to some of the funds. And I was taking a look at a couple of funds here. Now, emerging blue chip was one which caught my attention, and also I was looking at the stocks in the funds, and it's a very interesting sort of picks for our viewers. Let me tell to them. We have Tata Power in that, Tata Chemicals, Cholamandalam Investment Finance. That stock has been 3 times in the last 3 years. Gujarat Gas, we have Dr. Lal from the healthcare sector. We have chemical stocks, paint stocks, material suppliers. We have a bit of IT stocks also there. It's a sort of a very unique sort of a balance here. From medcap perspective, sir, and from a sectoral perspective, I'm asking on a top view question. Obviously, I'm not asking on a stocks. On a top view question, right now, which sectors would you think that is going to drive the 2023 earnings?
See, we if you go back to say 2021 or 21-22, became the base for say what we call value stocks. And at this moment, if you look at the market, value looks like growth and growth looks like value. So the broad sectors which we definitely feel are looking good for us in the next 4 or 5 year horizon. I did mention that, we are seeing a shift to manufacturing. So we see great opportunities in manufacturing. In fact, we formed a very good manufacturing index, which people should also check out from our basket. It's a very unique product in the entire market and only we have it. But broadly, our views on manufacturing remain very constructive. We've been always pro financials. And then today, Nifty 50 showcasing 37% financials is cognizant of the fact of how important they are in the next 4 or 5 years. We feel pharma has definitely bottomed out, and that's something which we find a lot of value in. And selectively, there is revival in auto, and some of those spaces look okay with us. You have to be selective in discretionary consumption, and there could be some possibilities in that. So the simple point I'm making is if you take out the erstwhile value perspective of the portfolio, we are seeing good value across the market, across segment. We are a little watchful on IT, if I were to give you the other side, because the global data on IT could unfold again adversely. If one has a longer horizon on IT, one can take that. But at this moment, we are a little watchful on IT as we speak. But you just need 50 to 60 good stocks, and there are enough ideas within these segments to give you 50 or 60 strong ideas in the portfolio, and that's what we concentrate on.
I want to talk on healthcare, but before I go to healthcare, I want to spend this question on the auto stocks here. The auto sales numbers have been stellar. We have seen again the two-wheelers are doing well, tractors are okay. The season has been kind to them. The Rabi season has also been kind to them. Rural incomes are looking okay. So from that perspective, when I look at that, And when I look at your fund construction, it tells me that you're focusing more on the auto financing, because I'm actually seeing very less composition of the auto sort of major auto stocks. Yeah, where you are seeing really seeing a sort of good stable momentum in the financing part, or
Piyush, if you track us since inception, we've been more auto ancillary and people who support auto than pure auto. That's been our style. So what you tracked is a very interesting part of our portfolio construction. So yes, we see a lot of what can I say, opportunities in factors which support auto, because at the end of the day, four wheelers are selling, but two wheelers can do much better. Is our submission of, and that's the factor of post-COVID impact, is that two-wheeler sales can do better. So we're waiting and watching that space a little closely. But yes, what you say is correct. We've been more auto ancillary guys than mainframe auto guys.
yeah, I remember when actually I was into the research part, that was a sort of conclusion that auto ancillaries universally have the mode, generate higher return on equity. So,
In
absolutely.
fact, if you go back and check emerging blue chip, one of the first introduction of a very famous battery company now had happened through emerging blue chip into the industry.
Absolutely. Now, on the healthcare, and this is something I think which a lot of investors they have been actually talking about over the last 2 years. Many times we talked about it. Perhaps now healthcare actually will bounce back, because it had been very stellar bull run from the sort of late 2000s, and then again from last couple of years we saw sort of healthcare sector giving us less returns. If you're saying it's looking like it's going to bottom out, where you think perhaps this time the value actually will go? It's going to be sort of mid cap healthcare outperforming, or particular part of healthcare you're looking sort of with more positivity?
See, I think I'll take this opportunity to also emphasize on the fact that, please don't confuse a sector with a theme. When we talk about healthcare, or we talk about banking and financials, or we talk about, say, consumption, these are themes. Say, pharma is a subset of a healthcare theme.
Yes.
When we launched the consumption fund some 12 years ago, it used to be practically FMCG. But if you pick up the portfolio of consumption, it's a well diversified portfolio. When I started my career some 25, 26 years ago, and late 90s, we started seeing mutual fund portfolios. The portfolios, you would read banks. Then it was bank, comma, NBFC. Then it became bank, NBFC, financials. Now it is bank, NBFC, financial, fintech. Similarly, when you look at healthcare, and we launched it 4 years ago, it was practically pharma. And now, as the theme starts growing in India, we'll have more hospitals coming in, we'll have more insurance coming in. It is a matter of time that large chemist chains will start coming public. And your personal health is becoming such a large part of your life. The simple point I'm making is, when you look at onboarding a theme into our portfolio, a theme is one which grows quite significant, right? And when we launched the healthcare fund 4 years ago, I agree with you that the valuations were very attractive, and we feel we are almost there again after 4 years, because you track that NAV in that it had doubled money in almost 3 years, and then we are back to a lull for a year, and probably restarting once again. But when you look at broad India and the possibility of penetration of healthcare and the possibility of re-rating of healthcare is abundance, right? And post-COVID, the importance of healthcare is there for all of us to see. My only grouse with this year's budget was lack of allocation to healthcare. I thought it deserved a little bit more, but it's a matter of time. And when you sit in healthcare, and broadly what you say is correct, is that there are opportunities across in mid and especially in the large companies after they have corrected. But it's a little tricky, because the index is skewed towards one or two companies, so one has to watch that from an index perspective and your allocation perspective. But I think in Vijesh we have a excellent healthcare fund manager. He's a pharma analyst up to healthcare as a fund manager. So we back him very strongly, and his performance has been quite satisfactory over the 4 year track record. But to answer your question, I think the opportunities are across from mid to large after this clean out or the valuation where we stand.
I wanted to ask you on hospitals, you already touched upon, because what we have observed in our the fund manager series, this is a very common theme. Uh, Everybody is liking hospitals, and I know a lot of hospitals are generating return equity. But I want to know from you: is hospital something where actually you are really finding a sort of good, strong performance? Because there was a period couple of years back where the hospitals were not generating ROCE, and now a lot of
See,
new players have got listed. And
I mean,
please say.
I go back to my discussion with my fund management team for some 4 or 5 years ago, and they had made a very interesting point that when you look at hospitals, there is a limit to the number of beds. Till you don't see the emergence of
Yes,
hospital chains coming about, this re-rating of hospitals will not happen. That we are beginning to see. When you look at the possibility of scale up of number of beds from any entity, that's when the story gets re-rated, and I think we are beginning to see that. And please, from a psychological perspective, please understand one thing: the hospital story is also directly proportional to the penetration of medical insurance. They go hand in hand. The more medical insurance penetration happens, the more the hospital story also unfolds, and you have to track them together. And if you see in the last 3 years, in particular, the medical insurance or the importance of medical insurance in an individual in India is just got highlighted. So from a hospital or a healthcare story, the story is just getting started, is an opinion.
right. So between a pure medicine or a pure insurance or a diagnostic or a hospital, which is the one theme which you like the most?
See, I'll pick the broad theme because I see everything unfolding very strongly. Because see, diagnostics is big. I mean, we are just getting warmed up in diagnostics. Of course, the kind of money that will get involved in that could become very expensive for people going forward as the diagnostic industry unfolds, as we see superior machines being brought into India for tests to be done. And we've seen some of it in the last 4 or 5 years, right? But I am always a fan of the healthcare. Uh, uh, it forms a fairly decent part of my portfolio. I'm making a disclosure here because it's a no-brainer to me, quite honestly.
Well, I support you. My family background is of healthcare, so I can
Wow.
understand what you're saying. So moving away from healthcare, you talked about the manufacturing, and I want to actually draw one insight from when you made comments on manufacturing. Um, are we referring to defense, which really has grown by leaps and bounds over the last 2 3 years? Now we're able to point out defense stocks in Indian markets. Apart from this, when I want to really look at manufacturing, which is a broader theme I should really search into, like manufacturing could be chemicals and all that, but which will be the broader themes which you think are emerging out?
Piyush, I think from a broad thing perspective, what has been the biggest issue of India? India has been lack of private capex, right? And thankfully, through the PLI schemes or whatever you put on the table, we are seeing offshoots of that beginning to happen. Though from a caveat perspective, I think some more work can be done from a policy level on land and labor reforms. Once that happens, and I hope it happens, then this can go into a very different trajectory. But we are seeing manufacturing as an overall and not restricting it to any simple pockets. You referred to defense, but there are hardly 4 or 5 stocks there, right? So you can't form a portfolio out of that yet. But my humble request, and like stay away from stocks as such, is just pick up our manufacturing index, which we have put on the table, and you see that portfolio. It's a fairly well-rounded portfolio catering to industries across, and we see value across that from a longer term perspective. We feel the manufacturing story of India is just about getting started, and once we see some amount of kick up from private capex into India. And thankfully, this time around, if you see, the government has taken the first step in the budget of putting their capex in the table. And
10 lakh
very
crores.
often you see policymakers coming and asking or urging Indians to step up the private capex. It's a matter of time. Once that happens, maybe not in these interest rate regimes, but once we get over that, you can see it happening across is our basic call on language.
Well, I can't actually let you get away without this last question of mine. Recently, you actually created a sort of fund or opportunity for the investors for investing in overseas markets also. Just help us understand that one also while we talk about entire domestic market. But let's also try and understand why the overseas markets could also actually give us opportunity.
Yush, I think this is a very good question, and it's been a big, what can I say, disappointment for us personally because at a fund level, because we had great plans of bringing some excellent, fund ideas from outside the world, outside India to India, but the regulations now have stopped us from doing that. And while the world is looking so attractive at this moment, some of the prices that are there for some of the stocks which were at a different level 3 years ago is there for Indian investors, but they're not able to take it from a direct fund perspective. But yes, there is this limited pool still available through the fund of fund route. And we launched two very exciting products, I must say. One is the EV product and one is the AI product just recently. And then our plans was to bring even far more graduated products than this. Our core portfolio still remains the S&P top 50. Just putting things in perspective, our Indian stock market is probably equal to just one Apple stock market cap. That just puts the things in perspective. And what happens, and I think forget markets, what really appeals to me in global investing is the diversification in portfolio that one achieves by owning different businesses which are not in India. Makes it a great sort of point to go out and buy those businesses, and there are enough funds with enough track record giving you that opportunity, and that opportunity being stopped for Indians or being curtailed for Indians, I think is a disappointment to us. I hope the policymakers review it and make investments a free flow avenue as it should be. I'm nobody to comment on lawmaking, but if it were open, then the opportunities that are there globally and especially in the US markets are pretty immense at this moment, purely from owning different businesses which are not there in India.
Absolutely. The EV and the AI idea actually sounded quite interesting to me, and that's why I asked you this question because it's quite unique. And at present, Indian markets don't offer anything like that on a fund basis. So that was something interesting. But with that, sir, you've been kind enough to answer all of our questions. And we also hope to keep interacting with you regularly on all the topics which are happening in the mutual funds.
No, thank you so much, Piyush, for having me, and wish all the investors happy investing. These are good times for investors, and they should recognize these times. Maybe a little long term in investing, but the person who stays invested this entire turbulent time will see a very different outcome on their portfolio post this.
Absolutely. And I'll wrap up the show with quoting one line from you only. For our viewers, $3 trillion market cap to $6 trillion, the youngest population, the largest population, all that basically is sort of almost music again to the investors here. And with that good thought, we'll wrap up the show. Thank you for watching us.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.